Now, since you even manage the ELSS fund, the tax saver fund, so does your strategy in any way be different for that fund compared to your other funds?
At the end of the day, our focus is very simple to try and generate as much alpha as we can for all our investors. And the LSS fund is nothing but another diversified equity fund, just like the value fund or a flexi cap fund or a large mid or whatever else you want to compare it with. So the focus, I think, is very clear.
Does your mindset remain the same across the funds which you are looking at when you're looking at a particular scheme to put your position your portfolio in?
You need to have, I think, what I call as the 3D strategy in your mind. So you need to have diversity in your thoughts and in your stock selection. You need to have discipline in your framework, and you need to have.
Is there by any chance a universe you maintain which is a negative list that these are companies which you will not look at all?
So in our company, it's an investment universe. I think we have an investment universe of about 650 odd companies. Typically, if a company is.
Hello and welcome to Ventura Spotlight. In this episode, it is a pleasure to have with us Mr. Daylynn Pinto, Senior Fund Manager, Equity at Bandhan Mutual Fund. Mr. Daylynn Pinto has a postgraduate in management from TAPI Institute at Manipal. He has over 20 years of experience in the mutual fund industry and currently manages the Bandhan Multi-Asset Fund, the Multi-Cap Fund, Bandhan Value Fund, Bandhan ELSS Fund, and the Transportation and Logistics Funds, which have a combined AUM of over 22,000 crores. So let's get started. So welcome, Daylynn, to our Ventura Spotlight.
So thank you for having me on the show.
So, Daylynn, we just try to understand that, how did you get into the equity side of the market? Was it a conscious decision or did it come by chance?
I would say it came by chance in some sense. I was a young guy who went in for my MBA without any prior work experience. And one of the first companies that came to my college for a placement was UTI Mutual Fund. And they happened to select me. And that marked my foray into the mutual fund industry. And at the same time, it marked my entry into the Indian markets in some sense. So one thing led to another, and here I am today, 20 years later, as a fund manager, equity fund manager. So, as I said, much more by chance rather than a very focused strategy of getting into equity markets from a young age.
So more of a discovery mode. So are you happy with that choice, or you think that you could have done something different?
No, I'm quite happy. I think I've grown much more than I ever thought I would. The beauty about being, I think, in equity markets is that you're always learning. So the learning process never ends.
Right.
So whenever you think you're a master of a particular subject, the market teaches you otherwise. And I think that's really the enjoyment, is that you typically never get bored because something or the other comes along, which gets you, which makes you humble and gets you back thinking about, how you can learn from your past mistakes, how you can try and fine tune your thought process, and try and make outcomes better.
So, just kickstart with a very basic question. When you are evaluating companies, we are now in an age where there is, information overload, right? I think same thing 15, 20 years back, we had to really seek out information, right? So how do you evaluate, how do you make yourself stand out since there's now a lot of information already in the public domain? So how do you go through your process of evaluating companies?
No, so I think that's a great question. I remember when I joined and I was an analyst, my boss used to tell me at that time, "You guys have it easy. You'll have Microsoft Excel." In our time, we didn't have the same thing. And when I look at the young analysts today, not only do they have Excel, but now the stock exchange gives you the results in Excel format, so you can just import it into your sheet. And these young kids write all kinds of code and programs to build a model with the click of a button in some sense. But I think what never changes is the ability of application of mind. And I think there is no shortcut to mental application to improve decision making. And I think that is something that you have to keep learning, keep evolving, keep trying to fine tune to get better investment outcomes. So while a lot of the grunt work, as they say, can be crunched with technology and with, I don't know, AI, they say is going to, be the next big thing. But application of mind, gut feeling, the ability to pick up trends, I think that is something that, will always remain with the human mind in some sense.
So can you give some examples in terms of how you go about with your process of shortlisting your companies? Means what are the key parameters that you look at?
So I think there are multiple parameters. I think everyone has a different way of doing it. But I think, two or three common parameters that we all use. I think one is I'm fairly contrarian in nature. And therefore, when I see too many buys or too many sells on a particular stock, it evinces interest. So either too many people are bullish or too many people are bearish, and we need to kind of think, what can happen if they all go wrong. And it's a very tough call to take because you're completely swimming against the tide at that point of time. So I think that's really a true contrarian investor mindset in some sense. The second is, of course, the screens that you run. On a variety of financial ratios. There could be momentum screens, there could be valuation screens, there could be any sort of fundamental screens that you want to run, or technical screens for that matter. And it does throw up a few ideas that that you would then like to further evaluate, on a stock by stock basis. And the third aspect that I've been spending more time of late is also the macro aspects of how you want to construct your portfolio and what kind of risk reward you're willing to take on a variety of bets, right? Be it sector overweight, underweights, be it particular security, risks, etc. So I think it's a combination of all three that I use while putting together a framework when I think about how my portfolio should look and trying and figuring out what could be the probable return over a 3 and 5 year period from this portfolio.
Okay. So basically two things from that. One is that you mentioned, and now in data crunching nowadays, I think AI is playing a very important role. How much of AI are you looking at embodying into your data crunching? I understand that ultimately the analytical thing is a completely different skill, and AI will only help in terms of getting you the data much more faster. So do you see that trend happening very fast, or do you think that it'll still a while that you'll be able to get a proper data crunched using AI?
I think that's a tough question. I think people who are more fundamentally oriented investors at this point of time, I think AI still plays a smallish role in our decision making as far as buying and selling of stocks is concerned. So I think AI would probably accelerate for investors who are more quantitative in nature, who use a lot of quant, a lot of technicals to try and figure out what their trading strategies should be. I think AI will also accelerate in the research process, where a lot of data dumps, a lot of basic data analytics, a lot of time can be saved by the analysts in getting a lot of this together, or putting a lot of it together. So I think these are two areas where, at least in the near term, I see AI making a much larger impact as compared to, let's say, traditional long only fundamentally driven fund management. I think that will be the next step, but too early to say, frankly. Not to mention, I am biased.
Okay, correct. So the other thing is that being contrarian is sometimes very difficult, right? Because you have to wait out. It is more, I think, akin towards somebody doing value investing, and I think you are also more into value investing as a theme in your funds, right? So when you compare momentum, because momentum is something which gives excitement, right? So how do you balance yourself out? Do you get carried away by momentum, or you are able to stick to value, or do you, because fund performance also is required by the fund managers. So how do you balance that between momentum and value?
No, I think it's a very tough one because, like you rightly said, being contrarian or value driven is typically not doing what everyone is doing around you. And the toughest part about that is the longevity of wait before you're proven right, if you ever are, by the way. Um, there have been several times when you've had to wait maybe 2 years before a stock changed course based on your analysis or thesis, because markets can test your patience much longer than you actually think.
Correct.
I think every investor falls into both traps. There is what you call as a value trap, which is very commonly talked, and whenever anyone wants to ridicule value as a philosophy or an investment style, they typically give plenty of examples of how people fall into value traps, right? And they quote a lot of examples from the US market, etc. People seldom talk about how they fall into momentum traps, because they are as deadly, if not deadlier, than value traps many a times, right? Uh, dot-com bubble was a bubble that a lot of people got caught in plenty of momentum traps. 2007-8 in India, a lot of people got caught in infrastructure, which was a momentum trap at that point of time. Today's day and age, I'm sure in hindsight, we will soon figure out which have been the momentum traps, in this particular bull market that we are witnessing. So I think as an investor, you will get caught. I think the issue is how can you limit the amount of portfolio that gets caught in both these buckets, and these are typically extreme buckets, right? And I think that's where the earlier point I made about how I think about constructing my portfolio. How much of a contrarian view do I want to put in? How much of a valuation bent view I want to put in? How much of a momentum bent view I want to put in? I think a combination of all that, based on past learnings and experiences, I think is critical to have a more balanced outcome in how your portfolio should behave. And I think today that is really the key focus of at least my investment style, is how do I balance risk and reward in such a way that an investor hopefully does not have very varied outcomes, and has what I say a more pleasant investment journey rather than a very volatile investment journey.
Okay, so you want it to be a little bit more smoother
I think
journey, and not make it very volatile.
that's what I would hope my portfolio can do. Yes.
So since you are managing a very diverse portfolio, you have multi-cap, which could also be a little bit growth oriented. You have a value fund. You are also managing a sectoral or a thematic fund. How do you does it require you to keep on changing your mindset, or does your mindset remain the same across the funds which you are looking at when you're in looking at a particular scheme to your portfolio in?
Now, you need to have, I think, what I call as the 3D strategy in your mind. So you need to have diversity in your thoughts and in your stock selection. You need to have discipline, right, in your framework, and you need to have focus on dependability of the companies that you put into your portfolios. I think that's really the kind of strategy that I follow. So be it the value fund or be it the multi-cap fund, the cornerstone of how we're trying to construct the portfolios is with these 3Ds in mind, in some sense. What we also have is an internal definition of what we categorize stocks as value oriented and what we categorize as growth oriented stocks, right? And when it comes to a particular strategy like multi-cap, we are very clear about what is the exposure that the portfolio would have to both these types of companies, right? Whether it is value orientation or growth orientation. Similarly, we have similar thoughts on what kind of allocation we would have to a value strategy. And similarly, when it comes to a thematic, being a typical sector or maybe two sectors, which would highlight the theme. Uh, the investment philosophy is less important. I think the focus is more on the stock selection within those themes, right? So I think that's a little differentiated approach in some sense. So I think the idea is very simple. Uh, how can we effectively execute the strategies that we have communicated to the investors in the best possible way, without getting muddled into definitions of what is growth, what is value, etc., etc. So I think we have a very clear framework on how we look at it, and accordingly the allocations then are done across the funds in some sense. And do remember, we have a very strong research team behind this, and they make the job easier in some sense.
So, since you mentioned that you have to have a good set of companies, right? Now, generally, we see that, most fund houses or even research which you carry out, we always have a watch list with what we want to invest as an investment universe.
That's right.
I mean, we were just intrigued. Is there by any chance a universe you maintain which is a negative list that, these are companies which you will not look at all? Do you do that, or it's always a investment universe and not a negative list?
So in our company, it's an investment universe. I think we have an investment universe of about 650 odd companies.
Okay.
Typically, if a company is on the negative list or it's not in anyone's radar, it's anyway outside of this 650. So it's not that we have a blanket ban on buying any security. But typically, if no one is interested in a particular security, it's not part of the 650 list in some sense, right? To my mind, I think having a negative list may not be the appropriate thing to do, because I think the last 4 or 5 years, if it taught anyone anything, it would be not to have a negative list. Because most stocks on that negative list, I think, have given the best returns in the last 3 to 4 years, right? So
Correct.
it could have been power sector stocks that nobody looked at for a decade. It could have been defense stocks that nobody looked at for a decade. It could have been railway stocks that nobody looked at for a decade. So I think having a negative list gets you into a very nice, cozy comfort zone from which you never know what will come and hit you from the other side. So I think, to my mind, one should always be open to every single opportunity. And I have this favorite phrase that I keep saying, is that every security is a good investment if you buy it at the right price. Right? So buy at the right price is the key, and everything has a right price to be evaluated and probably to have a place in your portfolio.
Okay. Now, since you even manage the ELSS fund, the tax saver fund, with the new regime coming into play, and not many people would be looking at ELSS as a part of an investment theme, and typically we find that it is the individuals, the salaried class, who are looking at the ELSS fund. You have a 3-year lock-in, so you have that comfort with you. So does your strategy in any way be different for that fund compared to your other funds, or it remains the same strategy you follow?
No, I think we follow a similar strategy. See, at the end of the day, our focus is very simple, to try and generate as much alpha as we can for all our investors. And the LSS fund is nothing but another diversified equity fund, just like the value fund or a flexi cap fund or a large mid or whatever else you want to compare it with. So the focus, I think, is very clear. The only differentiating factor is the 3-year lock-in, as you rightly mentioned, which as a fund manager, maybe in the back of your mind, you take that to have the benefit of not having to worry about daily liquidity of your portfolio in some sense, because you have 3 years on a rolling basis of the money that's coming in. But other than that, I don't think there is any large differentiator for you to have a very different sort of strategy for ELSS as compared to any other diversified fund out there.
Okay. One more, just shifting on a more of a macro basis, is that if we see the last 5 years, we have seen a complete shift in the way how the foreigners are looking at the Indian market and how the domestic investors are looking at it. I mean, in fact, when you look at the data, last 5 years we have had a outflow of money, and the domestic is absolutely gone, gung-ho into the MF investments, right? So, is it something that we as domestic understand, or is it that the foreigners know something more, and are we not looking at the right thing? And how do you look at it from your perspective? As a it's a for you it's a good thing that you are getting more money per se, but how do you see it from a macro perspective?
I think it's a bit of both. I think the domestics have started to kind of realize the true value of equity investing over the last few years. Of course, recent returns do play a role in how people think about equities, but I think from an allocation standpoint, Indian households are still very, very underinvested in equities as compared to many of the Western economies. So I think there's a large potential there to channel that pool of savings into equities, and I think that's the most structural story. Nevertheless, as with any structural story, there are always cycles. So we reach there at the end, but it is never a straight line. And we've seen this in our domestic mutual fund industry as well, where every maybe 5 or 7 years, we have a down cycle as well, in terms of flows or in terms of the narrative that moves around, etc. So I don't think that anything has changed as far as that is concerned. At least that's not my base case. I believe that we'll continue to be an industry that will have some cycles. It can't be a one-way journey up, and it'll never be, of course, a one-way journey down. But structurally, I do believe that there is far more potential for us to continue to grow, as more and more households allocate savings towards equities. And like I mentioned, we are still underinvested. From a foreigner perspective, I think the last couple of years have been unique because one is we have had the US market, which has done well for a decade now. And foreigners like to compare how global markets behave. So India is just one of the many markets that they have access to and ability to make money in. And if they don't see too much of value, I think on a relative basis, they would pull out money from that market. And I think that's why you're seeing the kind of selling that you've seen by foreigners, especially in the last 2 odd years, where to their mind, growth has been slowing and valuations are expensive based on historical parameters. Now, there are a lot of arguments as to why that should be the case and should not be the case. And, I think many managers have argued why India should be more expensive. We've got better governance, better ROEs, better growth, etc. But foreigners probably are not buying into that argument on a structural basis. On a structural basis, they probably do, but not on a cyclical basis, right? So I think, these trends can change very quickly. I would not want to put too much weightage. I don't think foreigners are going to exit India forever. And I don't think domestic mutual funds will attract, the kind of flows forever also, right? I think both will go through their cycles. Currently, one is putting money in, the other is taking money out. Maybe the next 12 months, one will, the tide may turn or both may be putting money in. I don't know. So I think we need to wait and watch and see how this evolves. But no need to get carried away on any data point, is my opinion.
Okay. So, coming to India, basically, we require a lot of infrastructure in terms of we need to have a lot of things in place. And I think one of the thing which impacts it is also the transportation, because the roads, the more better the roads, it will lead to better number of cars, and even the railway infra, that all it comes under part of transportation. And we see that the biggest challenge in any other the online businesses is the last mile logistics, and I think you manage that one part of the fund on that. So how are you looking at in terms of the whole within the infrastructure, the transportation and logistic as a segment? How do you see it panning out in the next 2-3 years?
No, I think clearly infrastructure creation in our country still has leaps and bounds to go. You know, in a place like Bombay, for example, we get half a coastal road, and we are also excited, and it's made a lot of our lives much easier. Uh, but I think there's still plenty to be done. I mean, to give you an example, we started on the ambitious dedicated freight corridor project, which is a rail connectivity project
Right.
for cargo movement more than a decade ago, I think, and we've still not been able to complete. So there are plenty of challenges, as far as land, right of movement, etc. is concerned. Costs involved also are fairly high in many cases, and that is kind of, I would say, put the pressure on the pace of infrastructure development in some sense, right? So there is still lots to be done. I think there's tremendous efficiency yet to be gained. Whether it will happen in the next 2 or 3 years, I would hesitate to or hazard a guess to say that I don't think it can be done in a short period of time. But is there lots to be done, and is there lots of improvement that can be achieved? The answer is definitely yes. I'm very hopeful that we will continue to build brick by brick and improve not only our infra but our efficiency levels. Because if we want to really be a make for the world story, that is a very critical piece that needs to be still put in place in some sense.
Okay. So one of the ratios which we keep on looking at also, specifically when we are looking at infra, and we have seen a cleanup on the bank side itself also, is the debt equity ratio, right? I mean, which is now become more or less comfortable, but the interest rates are still iffy whether now they will go down or they will go up, right? So how much of leverage you look at in a balance sheet for you, that at one particular point of time that okay, beyond this it becomes a no? I mean, excluding banks and the NBFCs as a structure. But if you have to look at this one particular ratio into the balance sheet, what is a reasonably good ratio for you in today's circumstances?
So I think there are 2 or 3 parts to this. One is today no one's looking at the ratio because it's so low that nobody's really worried about it. But I think it also depends on the type of industry. So any industry where the cyclicity of profits is very, very high, typically you want that ratio to, I would think, not be more than 1.5 to 2x EBITDA. Businesses which are more utilitarian in nature, where cash flow stability is much more predictable, you can potentially go for higher ratios of maybe up to 3.5 in some sense. So I think that's the broad range. It's very industry specific here. It's also promoter specific. Does the promoter have other backing? Does he have other cash flows that can always be used in case there's a problem with the existing asset? So a lot of other factors that we do take into account. It's not just the ratio alone. But I think today we are facing the reverse problem. Today we are facing underutilization of leverage. So balance sheets are completely under-leveraged, and we are not seeing any urgency from companies or promoters to actually go and lever up, right? And part of the reason is because equity is so freely available today that most people are choosing to fund every expansion by raising capital from the equity markets.
Okay.
Right. So I think today leverage is not the problem. If at all, if you ask me, it is the lack of leverage that is more an issue at this point of time.
Oh, okay. So, in terms of your portfolio, when, one is when you buy and you hold, right? And the other is that now you need to exit at times. So what makes you exit a particular stock? I mean, is it that, okay, now you have some another opportunity which is coming up and that is better than the one which you have existing? Or is it that, okay, a particular stock is a run up and then you get out? So what makes you decide to exit a particular stock?
So this is never an easy question, and it is never an easy decision to make. You seldom like to sell your winners. You get connected to them, you get emotional about them. And it's really tough, frankly speaking. It's very, very tough. It's much easier to buy stocks than to sell stocks, actually. Okay.
Right.
I think 2 points you've already highlighted. I think one is I think about these stocks, have they reached what I call as an insanity premium, which means are they, baking in the not only the moon but maybe the entire solar system in terms of valuations, right? And then I say, you know what, it's just not worth the risk, and you want to cut down. So the first thing I do actually is I see what weightage these stocks are in the portfolio. And if they are at weights that are not comforting, which means that let's say there's a small cap stock that's at 3 to 4% of the portfolio and trading at very high multiples on peak profits of the company, etc., and whatever. We do our own dipstick on how we think about it. I think the first thing we do is, let's not stick with such a high weightage. Let's bring that weightage down to maybe 2%. And then let's reevaluate, right? So first we want to take money off the table. Let's not try and, ride the bull. Let's take some money off. Let's come down to 2% so that at least we can, we can withstand any issue if at all it arises, right? If at all it arises. I think the second step would then be to say that, hey, do I need to completely exit this name or not? Because, it's probably gone up another 20 or 30 or 40% after we've cut our exposure from 4 to 2. And then think about whether we need to completely exit and rethink our thesis. Have we missed something? Have we gone wrong, etc.? So I think that's the most common way that we think about, selling. And the third is, as you said, do we find a better opportunity within that sector? Where we say, okay, let's get out of this and get into that, because I think the relative valuation differential has become too wide or too large, and it doesn't justify this kind of premium. So I think it's a mix of all three points that you mentioned.
I liked your word, insanity premium. Okay, so according to you, how would you define insanity? I mean, supposing if I have to ask you that with a number or something like that,
I don't have a number, but I see a lot of companies that today are at manufacturing companies today that are at 10 times sales, 15 times sales, 20 times sales, and some of the top FMCG companies in India that make a tremendous ROC, have tremendous brand value, phenomenal cash flows. They themselves, trade at around maybe in that 8 to 10 times sales range, right? And they've been here long enough for us to know what the cycles and what the earnings volatility of those companies are. So when I see companies going into these bizarre type of multiples that we typically don't see, and I've just given you sales as one thing, but it could be on many other metrics. It just gets me to, it starts getting me worried on how to think about all this. And the more worrying factor is actually not if you find one company like this, but when you start finding hordes of companies trading at these multiples. I think the mistake we make is, and we all make the mistake of misanalyzing a particular company. So there could be a company that's at 10 or 15 times sales, but I have not understood what the business model is or what the growth path is or how this business can scale up, and I go wrong. But can I go wrong on 30 such businesses or 50 such businesses? I think there the probability is much, much lower. Okay. Right? So I may miss the winning horse, but all horses don't win the race.
Okay.
And I think that is where that insanity premium aspect comes into play, or is a very relevant thing to think about.
Okay.
I think most people focus on the winning horse.
Right.
They, slightly forget that there are 50 other guys also trading there, and therefore you need to be a little worried.
So one last question before we do a rapid fire with you. So being in this market, which is ever changing, ever evolving, sometimes stressful, exciting, right? So how do you unwind yourself?
I'm an avid sports lover. So I play a lot of sport. Multiple sports actually. Pickleball. My latest craze is pickleball, but yeah, I play badminton and volleyball. Anyway, a whole lot. It doesn't matter. I just love sports, so it doesn't really matter. So that's my way of unwinding. And the other is spending time with my kids. So I enjoy that as well. They're small, so they still love me. They've not grown to the age where they don't want me anymore.
They
So
still
I'm
love you,
enjoying,
right?
yeah. So I'm enjoying that part. So I think that's really the best way that I unwind. And I do watch some shows and movies and stuff. But yeah, but I think sports and the kids are the top two.
Okay.
Yeah.
So we'll do a little bit of a rapid
Sure.
fire with you. Okay. So one sector you secretly enjoy researching.
Oh, it's a tough one. Secretly enjoy. So it's an open secret. I love auto, but
Now it'll be open.
I think the new age companies.
Okay. Okay. What makes you more nervous? Fed announcements or stock advice in family groups?
Stock advice in family groups.
Morning markets or evening research? Which one do you like most?
Morning markets.
One financial term you would happily ban from LinkedIn posts forever.
I'm not much of a LinkedIn person in some sense. So I don't follow too many posts. So I'll leave it at that.
But one financial term if you had to ban.
This time is different.
Okay. If you were not a fund manager.
I'd be in the sports industry.
Okay. What's your go-to snack or drink on high volatility days?
On high vol days, my go-to drink would be, I don't know, whatever mood I'm in. So some form of alcohol, I would say.
Okay.
And my snack, some form of sugar. So
Oh,
maybe a chocolate or something. Yeah.
In one word, investing feels like.
Test cricket.
Okay. If you had to pick one investing quote to print on your coffee mug, what would it be?
I'd give a quote that I read about Benjamin Graham, where he says that investing isn't about beating others at their game. It's about controlling yourself at your own game.
Oh, very nice.
Yeah. I think in today's day and age, we're so obsessed with all our peers that we forget what our own philosophy and strengths are, and that's what we should follow.
Anyway, thanks a lot, Daylynn. It was a pleasure, speaking with you and understanding your philosophy. Thank you very much.
Thank you. Thank you so much. Thanks.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing.